Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I'm here with NEOS co-founder, Garrett. How are you, Garrett?
Adrian, I'm doing well. How you doing today?
Always love having NEOS on the channel. You guys are doing great things. You have some very popular income-oriented funds. I know typically I have Troy, but it's great to talk to the other co-founder. So let's have a great conversation here and talk about what's been going on with your shop. So you recently launched, let's just talk about NIHI. And in case, I'm going to share my screen in case my audience is not aware of this, but you guys have obviously the very popular SPYI and QQQI, as well as the Russell one. We'll talk about quite a few products. So these are index based, right, with a covered call overlay. And you came out with NIHI, which focuses on the MSCI EAFE index, which is basically developed markets outside of North America. Tell me all about this product. Why did you decide to launch it?
Yeah, thanks. We're excited about this product because we've talked to just a lot of investors over the course of this year. And even though most US investors are very domestically biased, people have been looking
Yeah.
for international exposure, right? Just hedge away from some of the administration, things going on, obviously, much more at the local level. And so we're excited. We partnered with MSCI to license the EFA index. And as you had mentioned, it's essentially developed international equities ex North America, so excluding the Canada and the US. But what's great about this index, not only has its performance been strong and the diversification opportunities it offers investors, but it also has index options. And so I
Okay.
think as a lot of your audience knows, being pretty deep and well aware of option-based strategies, those index options get that preferential tax treatment, which means here in the US, it's at least 60% long-term capital gains and 40% short-term. So we can match that long equity exposure with an index option, in a covered call format, to really focusing on, harnessing tax-efficient income capabilities, but with international exposure.
Awesome. Yeah. So if someone wants to diversify a little bit outside, geographic diversification, yeah, for sure, U.S. investors are definitely home biased, as they should be. I mean, my opinion here, some of the best stocks, best market all around the world. But hey, you have a chance for a little bit of diversification in case you're still an income cover call investor. Now you could get some of this index, which basically gives you advanced markets in Europe. I believe there's a lot of Japan, Australia, those types of, developed outside of North America. So what about the strategy? Is it very similar to what you guys are already doing with the SPYI and the QQQI? Tell me a little bit about the cover call strategy there.
Sure. Yeah. So before the covered call strategy, that EFA exposure we're actually going to get through owning an ETF. And then we just cover that out of the expense ratio, that we're already charging. So no additional layered fees. The reason why is that it's over 2,600 international securities. And so the most tax efficient and cost effective way for everybody is going to be with an exposure to the ETF. And then on top of that, it's very similar to what we're doing in SPYI, QQQI. We're using index options that are MXEA named. So that's the index option for the MSCI, EFA index.
Yeah.
And on that same kind of monthly cadence, we're going to rebalance our portfolio to look to write those options out of the money. So call it within this index is going to range, in that kind of 1 to 3, 1 to 4% range. And then we're also not overlaying on 100% of the portfolio. We're actually dynamically shifting that based on where volatility is. So as volatility gets
Mhm.
higher, we write on less of the portfolio. And when volatility is lower, we write on more of the portfolio. So you're getting more of a consistent income generation from the options market. But us, that differs from a lot of other investors, or excuse me, issuers, is we're looking to just meet a kind of consistent and reasonable income generation. And then we want the rest of the portfolio to be able to appreciate when the equities do. And so is instead of generating too much income by having like a static percentage overlay or a static level of those options, being able to dynamically set those each month is really what's awarding the fund the ability to have upside capture in addition to the income generation.
Yeah, it makes sense. And you have it here. It's you're holding the iShares core, probably the biggest one associated with this index, I believe. The most
Correct.
liquid one, they're typically the BlackRock ones. And in typical NEOS fashion, like you said, looks like you're gonna have fairly consistent monthly distributions. Of course, they're not always going to be exactly the same one, but fairly, consistent. And thank you for providing the cover call strategy, which I'm assuming is also applies to SPYI and QQQI. We spoke about it. So about one, like you said, 1 to 4% out of the money options, and you're not covering the whole portfolio. So you are getting some upside as well, not just the income, but both kind of, right?
Yes, that's correct. I mean, it's really markets volatility are very dynamic.
Yeah.
And so we feel that although it's a rules-based and systematic process for all of our products, they need to be taking into factors to really assess where markets and volatility are so that you can meet your reasonable and consistent distribution rate on a monthly basis, but be able to participate when equity markets do well.
Yeah, and this index, I'm assuming, well, I'm pretty sure it has lower volatility than the S&P 500, Nasdaq 100, hence the lower yield compared to, for example, SPY-I and QQQI, correct?
That's correct. It does have lower volatility. So we're looking more in that 8 to 10% kind of target range,
Makes
as
sense.
opposed to where like SPY-I is more in the 10 to 12 or QQQI is in that 12 to 15.
And you guys are always going for tax efficiency. I'm assuming here, just like SPY-I and QQQI, most of the distributions will probably be ROC.
Yes, targeting the same thing. We have the same opportunity to harvest losses, within the investment process, but then also those 1256 index options get that preferential, tax treatment.
Yeah, there's still a little bit of negativity around rock and misconception, but I encourage everyone to check out NEOS's video on rock. You guys made a really nice educational video that talks about rock in general and why your strategies generate rock. It's not because it's your money coming back to you or anything like that. It's just basically it's accounting. So I don't want to talk about it again, but I encourage people, if they haven't checked it out, check out the video on the NEOS website. Let's talk about the gold one you guys recently launched, IAUI, the NEOS Gold High Income ETF. Obviously, we know that gold has been surging lately. Tell me a little bit the idea behind this one and the strategy, how you're getting exposure to gold. Is this gold, physical gold, or is it the gold miners? Is it a combination of the two?
Sure. So really the impetus behind launching this product was let's take what has been a static allocation, a pretty large allocation in people's portfolios, but that doesn't produce any income and
Mm-hmm.
actually leverage the volatility. I think what a lot of people don't realize is actually gold has a fair amount of volatility, in it, albeit it might not be NASDAQ-like, but you can still harvest the volatility in a ways to generate income and now take what was a just a long only hopeful capital appreciation investment and let that precious metal appreciate to be able to generate income based on the volatility level. So we're excited. This product has been growing. It's amassed almost 200 million of assets, kind of in the last 3 to 4 months. Of course, gold has been on a tear, but the
Yeah.
way we're getting exposure into this is actually leveraging the physical gold ETFs for up to a 25% allocation. And the reason why is they can produce a thing from a tax standpoint called bad income. So if we're allowed to hold 25% of it within our portfolio, that doesn't classify within the bad income category. Then the other 75% is very much like what we do with some of our other products like BTCI in the Bitcoin space, where to get the rest of the exposure, we do an option strategy by selling an at the money put and buying an at the money call using flex options on GLD because we like the physical backed nature of
Yeah.
it. So no miners, no futures based. Everything is, although it's in options world, we're essentially using all physically backed gold exposures and then creating an option strategy. So those two pieces combined get you a full one-to-one exposure to physical backed gold,
Mm-hmm.
just because you can't own one product or you just can't own physical backed gold in an ETF with options on top of it. So you got to work through some structuring, but as investors should see, it's all just exposure to physically backed gold in the way that we're ultimately doing that with the options or the core holding.
Okay, awesome. So no gold miners here. This is the more boring physical gold. And you're actually right. I was actually surprised to see. I was looking at the volatility of GLD, or AK, the biggest, most liquid physical gold ETF. Very similar, if not slightly higher right now than the VIX, than the S&P 500. I was very surprised. Obviously, it could change every day, but obviously it makes sense how you're doing it. You're doing the options on the GLD, and then you have 25% in that ETF, which I'm assuming is the one I'm highlighting here. So one to one, you have access to the price movement of physical gold, and then you're writing your calls or the options on the GLD ETF for the
That's it.
option
So we're
for the
doing,
premium.
yep, yep. So we're using GLD as the underlying, but we are doing a flex option. So it's able to be settled for cash, not called away early, and never have our GLD or any other positions called away from us. So it is exposure to GLD because it's the physically backed gold. And it's kind of the same construct as our other covered call strategies within our product suite. So again, we're writing, out of the money calls. They're going to range different percentages. Within this is a little closer, probably more to like the 1 to 3%. Because if you think of
Okay.
history, gold is not quite as volatile. Obviously, more recently, it is, but we're also only going to overlay on a percentage of the portfolio, right? And that is going to shift ultimately throughout. Like as of now, I would say we're in like the 60 to 65% range, but very similar to all of our other products that could range, sub 50% when volatility is higher, and upwards closer to that 75-ish range when volatility comes in pretty significantly. Because again, if you focus on pretty much a consistent income generation that the options market would pay, then the rest of the time we want the ability for that underlying asset class to be able to appreciate.
For sure. Yeah, makes complete sense. And yeah, I mean, I'm not surprised to see the yield slightly higher, for example, than the SPYI, because if the volatility is maybe slightly higher on gold, the yield is slightly higher than SPYI, or very, very similar. So it makes complete sense. So very, very similar strategy to your other ones. Yes, you're getting those nice premiums, that consistent monthly distributions, but you're still capturing some upside of gold when it goes up. Perfect. So yeah, good time to launch that one for sure. BTCI, I want to talk to you about this one because there's, let's be honest, there's lots of Bitcoin cover call ETFs or income oriented products now in the US. Last I counted, it was like six or seven. But BTCI seems to be outperforming most of them. It's been doing really, really well. So can you tell me, is it the same strategy more or less with your other suite in terms of cover call coverage? And, we want to get those premiums, but we want to capture some upside as well.
Yeah, so generally same concept.
Hmm.
Um, I think one, Bitcoin obviously has a lot more volatility than the other. So the income level can be higher and the overlay percentage can be lower. And where we write those options, they can be much further out of the money. Just so that volatility level on each asset class or reference index is really going to be the primary driver of like differences within the option strategy. But otherwise, it's all a covered call. And for BTCI in particular, it's going to be very close to what we had just talked about from the structure of IAUI, because Bitcoin gets classified really as a currency here in the US. And as you think about it, currency ETFs actually aren't ETFs, they're ETPs, and they fall
Uh-huh.
under a different, registration called the 1933 Act instead of 40 Act. We want to be within an ETF, and so for that reason, we can hold, one or two positions within the ETPs of spot Bitcoin. So you'll see
Yeah.
that we have the VanEck HODL, and we also have iShares as IBIT.
Yeah.
So those collectively can get to the 5% threshold. And then we actually use CBTX as you pulled up here. The CBTX are actually the index option versions of
Hmm.
Bitcoin. And so we'll sell an at the money put and buy an at the money call on that other 75% of the portfolio to get you back to that 1 to 1 correlation with a backing of, spot Bitcoin. So that's like, again, just like we did in IAUI, that's how you're really getting your core underlying exposure. And then, as we talked about, we're writing covered calls using CBTX to generate the income. As like more of a frame of reference, we usually tend to be kind of at or under 50% of an overlay. So because of the volatility level, and those options are also going to be much further out. I mean,
Yeah.
I think off more recent versions and monthly rolls, we've been in like the 8 to 15 to 20% out of the money range on those just because of how high Bitcoin volatility is.
Yeah, so you're capturing more translation. You're right now because of the high volatility, you're capturing more upside if Bitcoin goes up, but you're still able to sustain a really nice, juicy, approximate, 25 to 30% yield range. I'm assuming here right now it's at 28, and in
Yeah, that's
typical
correct.
NEOS fashion, very very consistent, monthly distributions here.
Yeah, no, appreciate it. I mean, listen, for us, it's always about what the end investor is going to receive. So we're
Yeah,
very focused on fiduciary responsibility, focusing on the end investor, and then consistencies. And not to get into the whole rock discussion, I agree. We really want to produce and look at what is a sustainable distribution that can be generated from the options, but is also sustained by the total return. That way, you
yeah.
don't have that kind of NAV erosion that people see in a lot of other products.
Yeah, very popular product as well. About to crack 1 billion here, and I was just I know you're not going to want to discuss other competitors, but I was just doing some total return comparisons with BTCI and other Bitcoin related covered call ETFs, and I'm seeing that you guys are, after 1 year, we do have 1 year of data for BTCI, and compared to other ones, it's outperforming pretty dramatically. Even in the short term here, you have 3 months, and obviously Bitcoin hasn't had a great past 3 months, but you see that you guys are doing really, really well. What do you attribute, without talking about your competitors, of course, what do you attribute to why BTCI is doing so well?
So really, I think it comes down to like our rules-based process on our model, right? That dynamic ability on a monthly basis to be able to rebalance the portfolio for the out of the moneyness of the options, the percentage overlay, that is really what helps us in those kind of flat, especially talking Bitcoin, slightly positive, flat to down markets to generate the income, need that we're out there, suggesting and promoting to that kind of 25 to 30% range. But it's allowing for those price appreciations when we have it. We all know Bitcoin can just rally 10, 20% out of nowhere. So we really want to be thoughtful that in those cases, you're positioned in a way to be able to appreciate. So I think it's really that dynamic part of our model that can reset based on current market conditions relative to, our competitors that I think are probably a little bit more static,
Okay.
in what they do.
Yeah, I mean, after observing the cover call space for a really long time, over 5 years now, I've realized that, the more active the strategy is, typically the better it performs, or you have a chance of having higher performance than a more rinse and repeat static strategy, like you say. I like that static. I might use
Yep.
that one in the future. So before we get into what I'm really excited to talk to you about, you guys are about to also launch an Ethereum cover call ETF, I believe. Let's just say very similar concept to BTCI, right?
Correct. Yeah. We're excited about that one, just waiting for the final approvals. And then ultimately we'll kind of announce the launch behind that. But it's going to look very similar to what BTCI does, just focused obviously on Ethereum and the fact that Ethereum has even more volatility, right, than Bitcoin. So as we've just talked about across a wide mode of our products, it's always going to be focused on Ethereum and the volatility level of Ethereum for where all those options and everything are positioned. But same concept of long exposure and a cover call.
Were you guys able to snag the ETHI symbol? I'm just curious.
Uh, we weren't because there's another product already with that
Uh,
out there.
oh well.
But yeah, it'll be something else.
I'm just curious. I'm a curious person. So, okay, cool. So now what I'm really excited to talk to you about. So in Canada, we have a lot of leveraged covered call ETFs. They like to say lightly leveraged, modestly leveraged, 25%, 33%. Not that crazy 1x, 2x daily reset, just regular cash borrowing, normal leverage designed more for long-term buy and hold investors that just like the income, like a covered call product, but they want a little bit higher potential total returns, because we know that putting covered calls on something that typically goes up over time, you don't get the same performance, as you get less performance than just holding the underlying. So tell me about these new series that you guys are coming out with. I have some of the prelim data here. So talk to me a little bit about it. You're calling it the NEOS boosted. So I think you have one in the works for the Bitcoin, and you also have one in the works for your S&P and Nasdaq. So you're kind of like your SPYI and QQQI.
Yeah, so we have filed for a boosted series. What we're excited about is, right, we're always trying to give investors the ability to espouse their market views or their risk tolerances for what fits best for their portfolios. So the boosted series is going to give us the ability to give, as you had mentioned, right, a modest amount of leverage within the portfolio to really try to, target those investors looking for, added total return, higher amounts of monthly distributions. And so I think as you compare that with existing products like SPYI, QQQI, or BTCI, those I would say are in like the mid-range of our equity, offerings. So those are our equity high income. We'll have the boosted high income, but then we also have our hedged equity income. And so for investors not looking to take full market risk, like they might in the core, they're able to get a hedged equity version strategy. And so this boosted is really meant to be a complement to all of those to allow people to take on a little bit more longer term, right, added risk, but that's really to derive a goal of getting back some of that upside you give up within a regular standard covered call,
Right.
because that's where you got to generate the income. So if we can help add some risk back into the portfolio, then that's going to help everyone with, more total return and more, general exposure.
What can you talk about in terms of and yeah, I'm showing them on your screen by the way. So in case people didn't know, you guys have, the SPYI and the QQQI, but you also have the hedged equity income versions, which I believe used to be NUSI,
Yep.
NUSI for the NASDAQ one. It was very popular. Then you guys reintegrated back into your company here. And now you renamed it QQQH and then you have SPYH. So these are, I would say, hedge equity income. So they're like SPYI and QQQI, but you're hedging a little bit more. So you have even less risk and less yield as well. Talk to me a little bit about the yield, the boost series. How much leverage are they going to have? How much more risk, for example, are they going to have versus a SPYI or a QQQI?
Sure. So as we kind of think about the boosted, we're more viewing it as the ability to try to derive long-term exposure and leverage. So as you mentioned before, it's not a daily reset. It's not a
Okay.
weekly reset. It's not about, just adding so much leverage in a 2x, format that people have to trade the products around. The idea is still very much a buy and hold income-oriented allocation. And so, from times will be anywhere from, 25 to 50%, I think up to 50% leverage can be utilized within the portfolio. It's always done on a rules-based nature, as we always have been. So it's not active of, we feel like we should be adding more or less leverage. And so it's really going to kind of be more in that target range to be able to just allow for that more capital appreciation and higher income components than what you get in kind of like a standard cover call.
Interesting. Okay, so between 25% and 50% leverage, but this is not like the daily reset leverage. Like you said, this is still with the long-term buy and hold investor in mind. So for example, someone who owns SPYI wants a little bit more total return over time. Maybe obviously this is going to translate to a higher yield, but they still want to buy and hold or get exposure to the S&P 500 or the NASDAQ 100 or the Bitcoin. They could hold this one instead. Or like we were discussing earlier, they could actually mix and match as well. Let's say someone, it feels like maybe the boosted SPYI is a little bit too much leverage. They could actually do like half SPYI and half that one as well to kind of make sure they're at approximately at the 25% leverage range or something like that.
Yeah, no,
So,
listen, I love that. I mean, I think a big thing we talk about is, right, meeting investors where they are. Everyone
mhm.
has a different risk profile, tolerance, right, income need. And so I think one thing we always like to focus on with all 13 products across a lot of different asset classes, but now as we just talked today about more of the equity suite, right? The ability for people to choose a mix and match of building a portfolio of hedged or the core or the boosted could exactly match kind of the exposure and risk that they're looking to get, while focusing always on that tax efficient income from their core, equity benchmarks that they like to, own and hold.
That makes complete sense to me. Awesome. That's very exciting stuff. I mean, very, very exciting. So you have the Bitcoin one, the SPYI, the QQQI boosted ones coming out. Is the plan? I know you can't talk about future products, but are you starting with those and then maybe doing the boosted series for the your other products, or you're gonna wait and see? I don't know how much you could divulge.
Yeah. Listen, I think the way we always view like product issuance isn't just to launch a ton of products. We have competitors that have just multiple products coming out a month. We like to be very focused, institutional, and talking with investors to see what fits. Obviously, these are ones that we've heard a lot of, positive, interest in from investors, but we'll continue to bring out more solutions within whether those are more of like our sector focused products where now we've started getting into certain commodities, energy, those types of things. But like as we also look at this, like we'll see how it goes. But obviously we want to make sure we're providing the appropriate amount of solutions for investors without just throwing product out there. That's never been our goal.
Awesome. Thanks so much, Garrett. So yeah, NEOS guys, next evolution option strategy, right?
That's
So
right.
they didn't call that firm that for no reason. So you got your international exposure potential now with a cover call overlay. You have some gold, the Ethereum one's coming out. You got some boosted series coming out. You also have a real estate one as well that was
Yep.
relatively recent, and a bunch of other ones as well. So I encourage you guys to go on their website and check it out. Make sure to check out that rock video if you still have questions around rock. It's definitely worth a couple of minutes of your time, and always a pleasure having you guys on. Always looking forward to the new products, and I'm super excited for the leverage ones as well. For sure, those are going to be
Yeah,
great.
thanks. Appreciate the opportunity to come on today.
All right.